Part 4. Social Fund, Savings and Credit Policies. Social Fund Policies. Group members may borrow from the loan fund for any purpose, including investments, consumption or emergency needs. However, credit may not always be the most suitable option to deal with emergencies. For this reason, savings groups develop a social fund to meet the basic insurance needs of its members, and, if it wishes, other members of the community. The social fund provides grants or interest-free loans to members who encounter special problems or emergencies. The members should discuss what types of emergencies can be covered by the social fund, and whether these funds should be provided as grants or no-interest loans. The types of emergencies usually covered by the social fund are medical expenses or funeral expenses for immediate family members. Some groups also provide assistance to their members to meet life cycle needs such as births or marriages. The social fund, however, is not suitable to insure members against risks such as drought or crop failure, as these risks are systemic and when they occur are likely to affect many members at the same time. The group members decide the amount of regular contributions to the social fund. At each meeting, all members must contribute the same amount. The social fund should be maintained at a sufficient level to meet the emergency needs of the members. However, it is not intended to grow to a large amount. The group can decide to modify the amount at any time or stop contributions until the fund goes below the agreed upon level, but all members must make the same contribution at each meeting. The amount of contributions required will always depend on the types of emergencies covered and how often they occur. The types of emergencies and coverage offered to members and non-members, if any, by the social fund should be clear and documented in the group's constitution. The duration of social fund loans is not fixed, as emergencies can prevent the borrower's ability to repay within a specified time. However, the group should encourage social fund loans to be repaid as quickly as possible so that the money is returned to the fund and available for future emergencies. The social fund must be kept separately from the loan fund, because if it is mixed with the loan fund and used for normal lending, it will not be available for emergencies. To make sure funds are kept separate, the social fund is stored in its own bag. Savings policies. Savings belong to the group members and are considered assets, while loans are made from the group's assets and create a risk for the borrower because they must be paid back. Therefore, it is wise for members to build up their savings before they begin to take out loans. A community-based savings group provides a safe, convenient and profitable place to save, and there should not be pressure on the members to borrow. Members should feel confident that they can save regularly. Not only can poor people save, but they already do so. Savings are not always held in cash. In poor and remote areas, it is common for people to save in assets like grain, livestock, or household items. All of these assets are a form of savings, even though they are not in cash. There are, however, several advantages of saving in a CBSG. The group encourages people to save when they might otherwise spend money or give in to requests from family to buy things that may not be necessary. It is safe and more convenient. Savings can be easily withdrawn when needed. By using the savings as a source of loans for members, the savings earn a profit and increase in value. When they are kept at home, they do not earn anything. For poorer households, it is convenient to save frequently in very small amounts. For example, it may be quite difficult for very poor households to save $3 per month, but it is likely to be easier to save 10 cents per day. By saving more frequently, in very small amounts, the poor can build up their savings, and this improves the security of the household. In a community-based savings group, members save through the purchase of shares. The price of a share is decided by the group. At each meeting, every member must purchase between 1 and 5 shares. The share price is set by the group at the beginning of the cycle and is fixed for the entire cycle. At the beginning of future cycles, the share price can be changed, but it may never be changed during a cycle. This amount is recorded in the group's constitution. The share amount must be suitable for all members, including at times of the year when there is very little cash available. All members must buy at least 1 share per meeting and can buy up to 5 shares per meeting. For example, if the share price is 10 cents, each member can save 10, 20, 30, 40 or 50 cents per meeting, as they wish. The system is very simple, but the result is extremely powerful. In a CBSG, savings are flexible across members and over time. Members do not have to save the same amount as each other, and they do not have to save the same amount at each meeting. The Aga Khan Foundation and its partner never provide any external capital to the group. The savings of the group will grow through the purchase of shares, service charges earned on loans, and fines charged to members for breaking the rules of the group. Credit policies. The savings of the group are used to create a loan fund, from which all members have equal access to borrow in small, flexible amounts. The loan fund is kept in its own bag. Loan meetings are held once per month. All loan transactions, the disbursement of new loans and the repayment of outstanding loans, take place at the monthly loan meeting in front of all the members. Members should not be encouraged to take out loans that they cannot easily repay. Loans can be for anything and do not have to be invested in a business activity. Loans can be used for consumption or emergencies or whatever the member needs the money for. For example, loans can be used to pay expenses when the borrower knows that there will be income later to repay the loan. The group must establish its rules and regulations regarding its loan activities at the beginning of each cycle. These rules and regulations are recorded in the Constitution. All loans have repayment conditions, and there are 4 decisions to be made for loans: maximum loan size, maximum duration, service charge, and repayment structure. Since the group uses the members' savings as the loan fund, they must agree on standard conditions, a set of rules to ensure transparency and fairness. The maximum allowable loan size is 3 times the savings of the borrower. This means that if a member has a total savings of $10, they can borrow up to $30. Members should never be forced to borrow or to borrow more than they need. Members can borrow any amount up to their individual loan ceiling. The group must first agree on the maximum loan duration. When loans are short-term, most people in the group get a chance to borrow. In the first cycle, the maximum duration of loans is 3 months. In future cycles, the group can decide to extend the maximum loan duration, but it should not exceed 6 months. The group must then determine the monthly service charge on loans. The service charge should not be confused with interest paid to an external institution, like a bank or microfinance institution. The money raised through the service charge belongs to the group and always remains with the group. It is not paid outside the group, as it would be if the members borrow from a bank or a moneylender. Service charge earnings remain in the group's loan fund and are returned to the members at the annual share-out. The monthly service charge can be whatever the members decide. Most groups charge between 1 and 10% per month, depending on the local cost of borrowing in the community. The decision is entirely up to each group and should be set in their best interests. It is not of any importance to AKF, as the organisation has no financial relationship with the group. Whatever the rate decided by the group, it should establish a service charge on loans to compensate members for their savings, cover potential losses from unpaid loans, increase the group's assets for lending, and discourage borrowing without a serious need or purpose. At the beginning of each cycle, the service charge can be changed, but it may never be changed during a cycle. The repayment structure of loans in a CBSG is flexible. The borrower can repay the loan in the number of instalments that they wish, and the instalment amounts that they wish, as long as the loan plus service charges are completely repaid within 3 months in the first cycle. At each monthly loan meeting, the borrower must, at a minimum, pay the monthly service charge on any loan. AKF recommends a flat service charge methodology. In the flat method, the monthly service charge is applied to the original loan amount, regardless of the remaining balance. In other words, the borrower pays the same monthly charge as long as the loan is active, no matter what proportion of the loan has already been repaid. The flat method increases the cost of borrowing, but since the earnings remain in the group, this results in greater profits at the end of the cycle. Moreover, the flat method greatly simplifies calculations, resulting in easier record keeping, shorter meetings, and greater transparency in areas with lower literacy and numeracy skills. CBSGs should avoid lending to non-members. Some groups have lost money by doing this. Groups that lend only to members experience very attractive profits without the need to take on too much risk. Groups that charge a 5% monthly service charge on loans often experience a 30% profit on their savings in each cycle. Groups may experience losses if they lend to non-members because outsiders will not feel the same duty to the group, but members should be confident that they will succeed if they follow the system.